Hello, my name is Andrew Thake from Minds and Money. I'm delighted that joining us today is one of the industry's most successful resource fund managers of the last 20 years. He's Markus Bachmann, fund manager with Craton Capital. Delighted that you're with us today, Markus.
Oh, thank you so much, Andrew. It's good to be here.
As an opening question, for viewers who are unfamiliar with Craton Capital, can you tell us a little bit about the company?
It's a relatively small company. We are a few investment professionals. We focus entirely on global resources, the dynamics that sort of like are framing them. We also look at precious metals in detail. And obviously with that macroeconomic analysis and all of that plays a very important role as well. Fiscal policies, monetary policies, etc. So it's we give a lot of emphasis to that kind of environment to then find the right kind of stock picks, the companies that you're investing.
And at what stage do you invest typically?
We look at across the board. We primarily look at companies that we think are undervalued, companies that have interesting projects where we see a significant value unlock. But per se, I can't say, you know, we just do large caps or we just do small caps. We invest across the board. We are passionate about investments, and we're going to go there where we see the best risk-adjusted returns.
Mm-hmm. How do you sort of screen stocks? Are there any particular like green lights or I guess red lights that you look out for?
Red lights are always there. You know, you look at the management track record, you look at the domicile, the jurisdiction, you look at the ore body. You know, these are all kind of criteria that we give a lot of emphasis on. ESG, of course, and ESG, I think it's not something you need to kind of like a tick the box exercise. It's something you need to live, you need to breathe. And we do that for many, many years, actually before ESG became topical. It's something we do since the inception of our products.
Has anything changed with in regards to how you invest with regards to ESG over the course of the last few years? So say, for example, obviously the World Gold Council of introducing their sort of mining principles, but is there anything that you're doing differently in 2021 with regards to ESG that you say you weren't doing in 2019?
Look, of course you do things differently, not massively differently, because it always played a role right from the start. The companies also have changed. And it makes it easier for us because they are very cognizant of the criteria of the perception that there is in the market towards mining. And hence there is a lot of improvement on that side as well, which makes our lives much more easier because you've got more information, it's more transparent. From that perspective, it actually became easier.
Mm-hmm. How are mining companies currently priced? Are they cheap? Or expensively priced against the current spot price of gold?
It's very difficult to argue with Mr. Market in that perspective. But when you look at the spot price, let's split that a little bit. When we look at the precious metal space, you know, gold, silver, PGMs, I think they are very attractively priced, also based on historical averages. The diversified miners or, you know, particular copper companies, nickel, zinc, etc. They are attractively priced. They trade at very interesting dividend yields, and that we haven't seen in my lifetime. You know, definitely much higher than in the last cycle, and I think they offer a very interesting value proposition to investors. If you take sort of like a 1-year view, a 3-year view, a 5-year view, I can't tell you what the market does tomorrow.
Let's ask a few questions specifically about gold. Why hasn't gold performed that well on a relative basis since its all-time high last year?
Look, it's of course a very good question, and it's the billion or trillion dollar question that everyone is sort of like wondering about. A couple of things. Nothing goes up in a straight line. When you reach an all-time high, it is often followed by a consolidation or a correction. We are sort of roughly $300 below that all-time high, which is, you know, standard. What probably, there are few factors that played a role. I think the entire tempering talk by the Fed, you know, played a role that people maybe take a wait and see attitude, and we will have to see how that plays out. The bond market is always an interesting companion to tell you a few things, and bond yields were going up sharply at the beginning of the year, just to correct then, about 4 or 5 months ago, and then sort of like sideways, telling you actually that the expectation of inflation that there was in the market was maybe a little bit premature. Maybe also the expectations of massive economic growth or a rebound after the slump that we had last year was maybe a little bit uber positive, if you want to say that, and hence a bit more sanity came in. Also, what we have to see is that equity markets were still on a tear and are, and I think the Fed played its card not too well, because the market thinks that equities cannot really go down. If there is a correction of maybe 15-20% max, the Fed will step in with more liquidity, stimulus, etc., etc. So they feel relatively in a safety space, investors, and hence, you don't need to look too far in terms of finding or looking across other asset classes. And equity being that sort of like one-way bet for the last while, that was definitely also a very difficult competitor for gold as well.
Can you talk to us a little bit about the role of gold miners in the portfolio construction process, and I guess part of a well-diversified strategy?
It's a good point, which is often underestimated and ignored. We looked at it, and there were a couple of studies done in the recent past that actually, if you use gold mining companies as a part of a well-diversified equity strategy, it's actually very beneficial to the overall return and to the adjusted risk return profile of a portfolio. Gold miners have a very low correlation to the rest of equities. It's about 0.31, and hence, you can use it always as a sort of like a balancing investment, that if things go really well on the general equity side and maybe gold equities trade sideways, it's not the end of the world, because your portfolio returns are actually far better balanced. And when other things don't go too well because of the low correlation, gold equities tend to do really okay and sometimes deliver massive returns, and that again then helps you kind of risk adjusted return for your portfolio. It helps to reduce drawdowns. It helps to improve the Sharpe ratio. And obviously you don't want to bank the house, but it's actually quite a wise thing to do. To some extent, you can say that as well on general miners as well. The correlation is not as low as the gold miners to general equities, but as a part of a building block in a well-diversified strategy, it's actually a good thing to have.
Bitcoin, or rather gold and Bitcoin. Has the rise of Bitcoin cannibalized gold?
Again, a very difficult question, very challenging. Some people say it has, some people say it hasn't. Definitely, Bitcoin is attracting a new group of investors, which is now spreading quite a bit into institutional investors and hedge funds and all that as well. To some extent, it maybe has cannibalized gold on the fringes. On the other hand, I think there is space for both of them, because obviously also both react on similar triggers, like the expansion of central bank balance sheets, and Bitcoin has a very, very strong correlation to that trend. Gold reacts to that as well. I'm very interested in Bitcoin because I think it is a symbol of the digital age that we sort of are entering, and it probably will play a role in the global financial system, if we like it or not. So it's actually a wise thing to do, to actually get to the bottom of it and try to understand it. You don't need to like it. Sorry to interrupt you.
No problem at all. Do you personally invest into Bitcoin?
No, I haven't.
Same here as well. Going back to other sort of like precious metals, you mentioned sort of like silver earlier. what is your outlook for silver this year? I mean, last year silver outperformed gold. Do you think it's going to be? What do you sort of expect to happen for 2021?
Yeah, we only have a few months left, and but maybe if we cast the net a bit wider, looking into 22, 23, silver is always a little bit the wild child, and it tends to do what it wants. And going forward, I'm more positive on silver than on gold. I'm constructive on gold, very constructive, but silver also has a couple of very interesting industrial applications that also will play in the next decade a very important role. And then of course, it is often used also as a inflation hedge, even more than gold, rightly or wrongly. I expect if the markets turn, might that be today or within the next few weeks or within the next month or two, silver will do better.
As an investor, how do you play the silver market? Because often when it comes to a lot of companies that say they're silver companies or have silver in their name, they're often not kind of pure silver companies. It's either silver and gold or it's silver and zinc, etc. Does that make it a little bit sort of difficult as a portfolio manager if you say, okay, I want to have a certain allocation into sort of silver, that there aren't that many pure silver mining companies out there?
It can be challenging, and it's actually funny that you say that, because you often have companies with silver as a name tag, maybe only 40% of the portfolio, and when silver turns or has a good day, these companies actually go into top gear. For us, it can be challenging because the pure silver companies are not too many to find. And sometimes you compromise by actually going for a company that has silver as well as gold, and you get the additional torque from the silver exposure. But it's always wise to find companies with good management, good assets, good balance sheets, and then you should be safe if you buy at the right time.
As I mentioned at the top of the interview, you've sort of been in the industry for many years. You've sat through, survived and thrived through a number of mining cycles. Are we in a commodity super cycle?
I think we are.
And you're
it's always tricky, between 2004 and 2011, commodity super cycle was sort of like the go-to word. And shortly thereafter, after sort of the market has turned in 2011, a couple of investment banks came out and said super cycle do not exist. They do. And you can do sort of a bit of an in-depth study, and there were at least sort of like 4 super cycles over the last 150 years. I think we are at the dawn of a new, call it upcycle. Maybe we substitute the word super cycle with upcycle, and we think it's going to be a long one and a sustainable one. And obviously there will be always setbacks. I mean, we saw one over the last couple of months, but there are a lot of conditions in place that are quite constructive for an extended cycle. And when I say an extended cycle, I'm talking about 5 to 10 to 15 years. And maybe I can sort of recap those. And maybe we have to go back a little bit into recent history, where we have sort of the genesis of that new upcycle, which is the lack of investment. We had sort of like a super cycle going bad for a lot of investors 10, 15 years ago, when the increased commodity prices were not reflected in super margins. We had a huge element of cost inflation, and that also resulted in quite a big discontent by investors. And the feedback to the companies was, look, that's not going to work. You can't always sort of like increase capacity, build new projects, etc., which is in a way, excuse me, a tad cynical, because the same investors 20 years ago, when China entered the WTO and all that, were actually demanding and kind of like delivered the capital to the companies by saying, look, there is now China in sort of the equation. You must invest. We need more capacity, etc., etc. that has changed. I think I wouldn't call it sort of like an investment stop, Andrew, but a lot of companies about 10 years ago said, look, we A, don't have the money, B, we have a lot of debt, so we cannot afford to build new capacity. And by the way, also commodity prices sort of like corrected or imploded. And hence you had sort of like an investment stop. And that is sort of like the basis that we have to deal with over the next, or the point of departure. Now, all of a sudden, we have very pedestrian supply growth, at best. We have no new massive discoveries. We have no new massive projects coming online over the next 10 to 15 years, actually, to increase that ever growing demand into COVID, into climate change, into ESG. And ESG can also be a little bit of a handbrake on new kind of like projects and investments, because it's not regarded as ESG friendly. I think that is wrong, but we can maybe talk about that separately. But as it stands, you have companies that are healthy, having barely any debt, pay huge dividends, but the cash that they generate is not necessarily invested in new capacity. And hence, for the next 5 to 10 to 15 years, you're going to continue to have that solid underpin for commodity prices. And I think this is a highly fascinating and very interesting, proposition to investors that is actually worth doing a little bit of homework. So the genesis, it's actually not the demand that will sort of like drive that upcycle or that super cycle, as you can call it. It's actually the lack of decent supply growth. And that's not going to change over the next 5 to 10 years.
Yeah. In your previous answer, you touched on briefly COVID-19. How well did the industry react to COVID-19?
You mean how have the companies reacted? Look.
Yeah, I think the mining industry as a whole. Yeah.
The industry as a whole.
Yeah.
Look, first of all, the industry had to go into sort of similar lockdown restrictions like the rest of us, like the rest of the economy. They came relatively quickly out of that. So a lot of the companies went back to, call it sort of like normal sort of operations in due course, maybe 5 or 6 months after the lockdown. Western Australia was actually quite blessed. They were hardly impacted by lockdown restrictions. And the industry was also on the forefront in terms of vaccinations. So by and large, the industry dealt in a very, reasonable and constructive way. And of course, sometimes you have to, maybe stop an operation for a few days or so because you had an outbreak, etc. But by and large, the industry went back into normal sort of like standings relatively quickly. So they dealt with it okay. Some of the issues that the industry has to deal with, but that goes everywhere, are supply chain issues. Because of COVID, the chip example is a very well-known one that is more kind of like impacting the car industry. But obviously for the mining industry, you had also issues with, yellow equipment, etc., etc. But by and large, I think it is temporary, and hopefully in 12 months time, 18 months time, things should be back to normal. But pretty much normal they are right now. But
how did it impact you at Craton Capital? Because I would imagine, I might be like wrong on this, but typically when you invest, my guess is that you like to either have a prior knowledge of the management team or have met them face to face, or you'd like to have done a site visit. But obviously over the last 18 months, doing site visits, I guess, has been pretty sort of tricky for you. And obviously having face to face meetings with management teams has obviously been quite hard as well. So how did COVID-19 impact the investments that you were able to actually do?
Not a lot, actually.
Okay.
Obviously the site visits, that they were falling away, but I think you can make an informed decision actually without staring into a hole in the ground. And a lot of kind of like companies these days are also quite diversified in their assets globally. So information is always there. The companies reacted swiftly by doing a lot of virtual tours, instead of site visits. So there is no excuse for not having the information. Access to management, it's always possible. And as we as a team have been around for quite some time, we have those relationships, and you can pick up the phone, you can get on Zoom, and you can have an interaction. And often actually it became even more efficient because you didn't have to travel. You didn't lose time on planes or in hotels and all that. So you could actually get more work done. And maybe for new ideas, to meet face-to-face a new management team, that maybe was lacking a little bit. And hopefully, as COVID restrictions will go away, that will be a possibility again.
Just in terms of, you just mentioned virtual site tours there, I'm just quite keen, is like how comparable are virtual site tours to the sort of like real thing? I'm just kind of, because obviously, we've all been to events like PDAC and Indaba over the last few years, and the rise of VCR headsets is obviously, I guess, a big thing that you notice on the exhibition floor. But how good have they been for you in practice when you've been doing these virtual site tours?
Look, it's been okay. It's been really helpful because the companies have been very professional in putting those videos together. But obviously, it's not, you cannot compare it with a real site visit. On the other hand, you can also pack a lot of information in there as well. And you can consume more of those kind of like virtual site tours, and hence it's a trade-off. Obviously, what is missing, that you cannot talk maybe after the official site to people of the management team, read the body language, and all these kind of things, where often you also have very valuable takeaways. But also remember, it's also very critical that you always understand from a top-down level, where do you stand? Is it the right time to invest in copper, uranium, and all these things? And you need to do your homework first before you then take the companies that you think are very well fitted for a strategy. When you said we're going to go, more aggressive on uranium or battery metals, when you do that homework and then put the building blocks together, it should pay well. And, site tours, very important, but always put them into context that you need to pull the trigger at the right time.
Would you ever consider investing into mining technology as opposed to mining companies?
Not in our precious metal fund, probably, but the Global Resources Fund would give you that opportunity to do so. And if we have interesting value propositions, we definitely will look at it. Obviously, it will play a role at the fringes. It won't be necessarily a core investment because people want to get an exposure into a copper company or a nickel company or God knows battery metals, but it's definitely something you should follow very closely.
A couple of final questions. Looking ahead to 2022 and the next few years, you mentioned ESG earlier, and obviously ESG, decarbonisation, and the green economy are going to be kind of key themes, I guess, we're going to see within the mining industry. How do you see that as sort of transforming the industry? And I guess the question behind it is, do you see that if the industry kind of gets it right, we as the industry can perhaps sort of attract in more investors, attract in general investors, and actually start to win those over? So there's actually like an opportunity there for the industry.
Look, there's definitely an opportunity as well. I think what also needs to happen is an educational process within the investment community as well. Because I think, a lot of people talk about ESG and don't have a deeper understanding what ESG actually means. And there also must be a realization that, with these climate goals that they are, and to electrify the global economy and to decarbonize, the global economy, you need all these metals. And by saying, we do not put any money into exploration, for example, is in a way also hypocritical, because you will need copper, for argument's sake, for, you know, a normal EV has 5 times the amount of copper than a normal traditional car. Now, where do you think the copper is coming from? From a 3D printer, you know? Now, first you need to find it. And hence, you know, I think the investment community need to have a very, you know, honest look into the mirror and said, actually, yes, by actually investing there, we can maybe do good things. We can influence, you know, better decisions, but you need those products actually if we want to achieve all these targets that they are. And these are often political and regulatory targets, and hence very difficult to negotiate. They are there, and hence, you know, the economy and investors have to comply. That's going to make it interesting. And maybe circling back quickly, if you allow me to, that's a big difference to the last cycle, commodity cycle. The last commodity cycle was mainly about China, you know, China entering to the WTO, China using this, China needs that, etc. And it's a lot of bulk commodities and all that. Now, this time, it's a global thing. We talk about a global ESG drive. That's sort of like these goals that they are, you know, they are very challenging and are sort of a challenge to every country. And hence, it's not only China, it's the Western world, it's, you know, India, it's China, it's Japan, etc., you name it. And hence, literally the momentum behind that drive. And it's political as well, because you set regulatory targets that need to be achieved. And hence, the momentum is far more powerful than sort of like 15, 20 years ago when the last cycle started. Plus, you have that sort of like tricky point where your supply is constrained because of a lack of investments and, you know, more of a distant approach by investors by saying, look, this is dirty. They dig things, they dig holes into the ground, etc., etc. And, you know, it's coming smoke out of the trucks, etc. Just to be a little bit simplistic, but what I tried to say, you know, it's actually, when you connect the dots, the industry now is in an absolute sweet spot. You know, barely any debt, balance sheets look really good, operating margins look great, dividend yields look great, you know, and you have that constant ongoing sustainable support for prices. And obviously, you know, there will be ups and downs, but on a down, you should actually taking a view, and that would be an interesting entry point. Well, sorry, I was digressing a bit.
No, that's actually no sort of problem at all. And but I think on that sort of like positive sort of point, and I certainly kind of like agree with you. I've been in the industry like less long than you've been, but it's certainly to me the most positive time I've been in the mining industry, certainly since I joined back in 2014, where the situation was fairly dire and depressing.
Absolutely.
So it's kind of like great that we're in sort of a much more positive position than we were like a number of like years ago. So I think that all that remains for me to do is to go and thank you once again for your time, Markus. That was Markus Bachmann, fund manager at Craton Capital. Thank you very much.
Thank you, Andrew.